Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is September 8th, 2016, and my guest is Chris Arnade. He holds a PhD in physics and was a trader on Wall Street for 20 years. In 2012, he left Wall Street to photograph people and to explore the lives of some folks in forgotten corners of America and to write about them, drug addicts, the poor, and others. And he writes thoughtfully on Twitter and elsewhere, and we'll link to that. Chris, welcome to EconTalk.
Thanks for having me.
What we're going to talk about today is your evolution from trader to photographer and what you learned along the way. And, of course, you were in a front row seat for some important moments of American financial history in the recent decades. And now you're in a front row seat of a place where there aren't that many people seated, which is the people exploring the lives of folks who are struggling in America in particular ways. And I found what you've written about both of those things, trading and your photography work, to be absolutely fascinating. So I want to start with your work as a trader. I want to start with the Mexican bailout, the Mexican crisis. What were you doing at that time in the trenches? This is in 1995, but what were you doing in the lead up to that, and how did you experience it?
Yeah, I had gotten, first of all, thanks for having me again. I had gotten a job offer from Salomon Brothers, one of the premier bond houses back in the old Wall Street, the one that's written about in Liar's Poker. I got that offer, and I joined in August 93, coming out of a PhD program in physics from Johns Hopkins. And I came to Wall Street knowing nothing about Wall Street. 6 months earlier, I didn't know what a bond was. I didn't know what a stock was. But I had found out there were jobs being offered to people like myself on Wall Street, and I trained myself. And they had put me in research. And my job was to apply my mathematical analytic background to look at trying to judge value and trying to understand the financial markets. And in particular, I was focused at the time on the international markets, something that had just started to get back into being hip again, which was investing in Latin America. They called it emerging markets, so Mexico, Brazil, Argentina. And for the first year on Wall Street, I helped the traders think about the products they were selling, think about the markets. And sometime middle of 94, actually I think it was November of 94, I was promoted to the desk to trade, be a trader in these products we were selling into Mexico, into Brazil.
A little learning is a dangerous thing. It's exciting.
Yeah, those first years that first year and a half was a quick immersion into learning about markets and trying to forget a lot of my math and physics. But they had promoted me to the desk really quickly, and within, I think I started somewhere in November, December, on a trading floor, the ones you see on the TVs with, a large empty floor with maybe 500 people sitting in front of computer screens, all next to each other. And the product we were focused on is helping clients, as well as helping our own bank, Salomon Brothers Investment Bank, invest in Mexico. And Mexico was a hot product at the time. There was NAFTA. There was a bunch of strong incentives for people to get into Mexico. And so we offered them a product to get into Mexico. And then very shortly in my career, December 20th, I believe it was, in 1994, Mexico, which at that time had what most countries had, which was to offer incentives for people to come invest in their country, they basically had their currency fixed. They remove any risk of devaluation, any risk of any additional confusion. They said, well, our currency is going to be fixed, the Mexican peso. And then on December 20th, they changed their mind about that, and they devalued the peso.
Yeah, it's fixed until it isn't.
Yes, it's fixed until it isn't. And that set off a whole chain of events. I think they gave it the name the tequila crisis.
Yep.
That was in many ways one of the first tests of kind of the new financial model, what that point was, and a test of the new incoming Clinton administration and how they would handle their dealings with the financial markets, which at that time was undergoing large changes from sleepy private partnerships to large public companies, and largely being deregulated.
And I would add people investing their own money to a world where people were investing other people's money.
Right. That was part of the
transition from partnership to public company was, I've suggested, is partly the attractiveness of being able to borrow money, and which had not been the case particularly before that.
Yeah, I mean, that's very much the case. And when I joined Wall Street in '93, it still had the culture of a partnership. And a lot of the senior managers still behaved as if this was their company, in the sense that their money was invested in the company, and what happened to the company happened to them personally. And that changed over my career on Wall Street. But the Mexico crisis was really, in many ways, the first test of the new global financial markets. And I want to talk
before you go on. I want to talk briefly about the kind of product you were selling, which was somewhat complicated. We don't have to go into all the details, but I think it's interesting when people think about, this sector of the world markets, or this country is doing well. I ought to get in on that. It's not so straightforward because, for one reason, sometimes, especially in emerging markets, they don't have a well-developed stock market where you could say buy an index of their stock funds. And so it's not always what was creative about what Salomon Brothers and other banks were doing at the time was giving investors an opportunity, a vehicle for investing. And it was a complicated vehicle, correct?
That's correct. My desk job was not in equities as much as bonds, and helping people invest in basically Mexican government bonds. And that's harder done than said, because there's a lot of regulations, there's different tax regimes, different issues that people generally don't think about, like, how do you prove ownership of a bond? You just can't go into a country and buy a bond and, be done with it. There's a lot of issues, custodial issues, ownership issues, regulatory issues, tax issues. And what our bank and other banks were offering was a simple vehicle. We sell you this vehicle that says you effectively have the ownership of a T-bill or a bond in Mexico. And
that was a bond presumably with an attractive rate of interest, because it was somewhat risky.
I believe the set days at the time where the Mexican bonds were 35% yield or 30% yield. But it was denominated in peso, so you had the risk of a devaluation. You took the risk of the currency between Mexico and the United States. Now, on top of that, besides just facilitating customers going in and buying these things, we also provided them leverage, and that was a big additional benefit.
Explain.
If a customer gave us $100, let's say, and said, I want to invest in Mexican bonds, we gave them exposure to $400 worth of bonds by lending them money. Kind of like, non-recourse financing, they call it, but very similar to what your $100 was a down payment on an exposure to a much larger size of bonds. So we lent money to the customers as well. It was a kind of structured product. We give you exposure, we get you invested in Mexico, and at the same time we lend you money to do it.
And let's just stop there for a second. The advantage of leverage is that the upside is very, very large, because you're only spending 100 of your own, but you're effectively holding, say, 400 of the asset. The downside is if it goes down, you can get damaged very badly.
That's correct. It's very much like it's supercharged. So I want to invest in Mexico, but I want it supercharged. And it's something that, started a very dangerous process of once we walked into the world of providing leverage, providing access was one thing. Helping customers get into Mexico is one thing. Providing them leverage, giving them supercharged Mexico access is a lot riskier. It's a lot more profitable, can be, but it can also be a lot riskier. And when the currency devalued, when the crisis started, it went from being very good to very bad very quickly.
Who were some of the customers? Who was buying these structured assets?
Well, a lot of mutual funds, a lot of pension funds, a lot of hedge funds, primarily hedge funds, but also we were doing it for ourselves as well. So we, the bank, had proprietary positions. So if we provided, we did customers with, let's say, a hedge fund in Greenwich, Connecticut. We would also, they would do 200 million and we would do 200 million because we would ride along, as they say. So we also were investing our own money in it because it was a trade that everybody wanted to do. And it was kind of what you call in Wall Street surfing the wave. When the wave comes, you surf it.
Strike while the iron is hot, make a killing while Mexico's having this great economic resurgence, and not just enjoy it, but amplify it.
And the period of time was very conducive to taking risk. We were coming out of a pretty rough recession from the late 80s, and Clinton was in power, and there was a NAFTA in the air, and it was, Latin America itself was coming out of default. They had defaulted in the 80s, and they were making these strong claims that there would be large trading global partners. So globalization was in the air, and so it was a natural thing to say, I'm going to take advantage of this movement, and I'm going to invest in Mexico.
And so why, just a small correction, I think the recession was in 91, and it was actually fairly mild. So I think it was more like a speed bump than a serious recession. And I think it did encourage a lot of people to be overly optimistic about how things were going to be going. And certainly the Mexican economy did very well initially as NAFTA went into place. What went wrong? Why did Mexico have to devalue, and why did they ultimately face the risk of default on those bonds that were the underlying asset for the products that you were selling?
A lot of people have a lot of different. A lot of people have different ideas. Budget deficits, current account deficits, spending too much money, not taking enough money in, having a fixed exchange rate. Generally, when markets go up too fast, they often go down quickly afterwards. I don't have a good answer in terms of what I think is the reason.
But at some point, it doesn't matter. I mean, at some point it became clear that the government of Mexico was going to struggle to repay the promises it had, to honor the promises it had made with their bonds.
Right. They initially devalued, once they devalued the currency, I believe it was 3.12 or something of that range, 3.12, and then they devalued it 15%, 20%. To give themselves a competitive advantage. They wanted to have a weaker currency so they could export more. But this hurt the investments of everybody in Mexico. So if you were a foreigner and you had bought one of my products or our products, you now lost a little money because Mexico had devalued. And that began an exodus. People started feeling very uncertain. They didn't have any confidence anymore in Mexico because you had told me the currency was fixed. Now it's floating. Now it's not fixed, so people started leaving.
And of course, that makes it harder for Mexico to use debt to finance any of the promises they made previously, because obviously...
That's correct. And so it became a vicious cycle where people started leaving, and that put more pressure on the currency, and the currency devalued more. They tried to hold the currency, but they were running out of money in terms of their central banks. And so it eventually got to be very ugly near the end of December, near the end of '94, into the beginning of '95.
What was it like in the office in those days?
Well, I had to cancel my vacation. It was, it was my first 6 months on the desk, and there was a sense of chaos. And I was supposed to go for Christmas vacation to visit my family in Florida, and that never happened. So For me, it was great in terms of personal because I learned a lot, and it was, to use a better, it was exciting. But it was a time and place where I believe I slept in the office one weekend, that first weekend, prior to Christmas, just trying to understand the positions we had been put in. One of the things I think a lot of people don't understand on the outside is, and some of the chaos that takes place in investment banking is, nobody really understood the product we were selling until the crisis happened. And then we realized, right. And then we realized, wait, we got ourselves into a very, very bad position. We had put ourselves into a really ugly position where we stood to lose a lot of money on risk we took we didn't understand. And so, when I say I spent a weekend in the office, that weekend in the office was trying to help the group understand what we had the risk we had gotten ourselves into. And that literally meant putting every trade and 2,000, 5,000 positions into a large spreadsheet by hand so I could graph the risk.
Just see how much money you might be at risk of losing.
And I remember there one day when Mexico had announced they were going to devalue again, I had a little printout of the money we would lose. We didn't know where the currency was going to open. It didn't open until 10 o'clock U.S. New York time. And during that weekend, I put together a table of, if it opens here, we lose this much. If it opens here, some of the numbers were huge. If it opens at 6, we lose $40 million. If it opens at 12, we lose, $500 million. And I just remember standing there, this kid who had just gotten this job on Wall Street with holding this little piece of paper and handing it to the CEO of the firm, who's looking at it and kind of blaming me. I'm just, delivering the bad news, but he kind of implied that I'd gotten us into this awful mess. So,
and what did it open at? Do you remember?
It opened, I think, at 5.8. We lost on that move about $25 million in that one day, and it came as a shock because no one had really thought they had this awful risk. And
of course, it wasn't over at that point. You didn't know.
No, it was by no means over. We didn't know where it was going to go. It just opened there, and we didn't know where it was going to go next. And for the next week and a half, it was really just complete, all hands on deck, trying to manage. I always say it's like being on a small ship in a hurricane, trying to always just figure out how to survive the next wave or blast of wind. Because when these crises happen, you start finding out you have all this exposure and risk you didn't know you had. Because it's kind of like in mathematical speak, it's second and third order effects that come into play.
But part of the challenge is it's one thing for you, as you said, Salomon Brothers had invested their own money, but of course they had sold products to a lot of clients who, when they saw the headline about Mexico devaluing, had a thought, don't I own some stuff in Mexico? I wonder what happened to that. And they call, and you have to explain to them that asset that you told them was going to be this fabulous thing, it's not so fabulous. So there must have been there's a lot of that too you've written about, right?
Right. Dealing with customers who are angry, the chief economist for Latin America at the time had written a piece on December 15th.
Chief economist for Salomon Brothers.
Yeah, for the Latin America, not for the U.S., who was chief economist who covered the Latin America region, had written a piece December 15th or December 13th saying the probability that Mexico devalues is zero. He didn't say small. He said zero. And then he went on vacation for Christmas. He never came back.
Yeah. So Chris Arnade missed his vacation. He got his, but not such a good deal.
So you get a lot. You had a lot of customers calling up saying, "Hey, you just said that the probability Mexico default was zero. What's going on?" So everybody was in a sinking ship, and people tend to blame whoever they can blame to get. And so you're trying to do a combination of survive yourself and also help your customers survive in the most equitable way. Some people aren't equitable, but we did our best to be, as above board as possible.
So the U.S. government at that point, somewhere around there, intervenes in a very, what was described by many at the time to be a modest intervention. They merely guaranteed $50 billion of Mexican debt, which gave Mexico the opportunity to refinance because people now knew that the U.S. government stood behind it.
That's right. And the person who spearheaded that movement was Larry Summers, who was just newly appointed, I believe, as undersecretary to the Treasury to Rubin. Mm-hmm. And it kind of became the blueprint for a lot of behavior in terms of government behavior towards Wall Street going forward. But our customers at the time had a lot of risk. We had a lot of risk, but our competitors, other banks, were doing this in much larger size than we were. So when the government bailed out, I'll use that word, when the government bailed out Mexico, and it wasn't just the government, it was an IMF, it was a consortium. When they did that, they really bailed out us, and they really bailed out other banks, including Lehman. Lehman was the one who was rumored to have had the largest exposure to Mexico, Lehman Brothers, who still existed then. So personally, it was a great benefit to us on Wall Street. It wasn't sold as that.
No,
but it really set in motion. It kept us from, it's hard to explain how much we could have lost because there were some very technical things going on. But when we had sold these products, we didn't really do our homework correctly, and we had a lot more risk than we thought we had. And there was a genuine chance that we were going to lose a lot of money had the bailout not happened. And that wasn't lost on, I don't believe that was lost on the regulators on the Treasury when they put together this bailout. They knew that Wall Street was exposed in a heavy way.
Yeah, so this really, to me, was kind of a turning point. We'd had examples like this before, 1984, Continental Illinois, but I always like to point out that Alan Greenspan is supposedly this great Ayn Rand libertarian. He testified in front of Congress about this bailout and said it was a terrible idea, but we had to do it. So basically here was the so-called great capitalist free market guy saying that we have to cushion the losses for people who made bad bets and have them lose zero instead of paying any price, the real price they should have paid. And at the same time, Time Magazine, I think this was the event that put Summers, Greenspan, and Rubin on the cover, the three men who saved the world. The idea,
right? And so,
go ahead.
Yeah, I mean, it really was. When you look back at the Times, and I look back at the Times, it really was sold as saving the world. And I can't tell you the relief we felt on Wall Street because we went from facing a $500 million loss, $250 million loss. It's hard to know what we would have lost to making money. And, they could easily say, and you said 6 months later, it all worked. Look, Mexico was doing better.
The guarantee never had to be invoked. It was free. The people,
right, and the Treasury can say, look, we made money on this. And then they did. Technically, they made money. They put in $50 billion. They got back more than $50 billion. So it became this viewed as this win-win. Everybody won. Yep. Treasury won. The markets won. What is lost, which is harder to see, and this is a big problem when you do policy. It's easy to look at numbers and say, look, my policy worked because the following numbers show that it worked. It's very hard to look at longer-term consequences. And certainly, I can tell you from a personal standpoint, one of the longer-term consequences of what that bailout was a lesson, I can get myself into a bad position, and I'm pretty sure I'm going to get bailed out.
And if I had a complicated asset and structured product that I didn't fully understand, and didn't lose any money on it the first time, the incentive to fully understand it the second time goes way down.
Yeah, exactly. It's kind of like, you go through a dangerous curve speeding, and your car kind of like, starts tipping over, but it doesn't. And you go through, hey, that was fun. Let's do it again. There's no consequences. And it really it's hard for me to explain to people who weren't there how much it really changed the culture. It helped transform the culture that was already transforming of Wall Street from relatively cautious banks, cautious because it was their money and they suffered consequences when they lost, to being these large bureaucracies that were generally felt no lesser responsibility to the broader markets and to themselves and to their customers.
So it's easy for us now, and with that hindsight, although you were on the ground and you have a different perspective than I do, but I always try to put some weight on people who at the time were aware of these issues. So in an essay I wrote on the financial crisis, I quoted Willem Buiter. I don't know if I pronounce his last name correctly, but at the time he was an economics professor at the University of Cambridge. He now is, ironically, the chief economist at Citigroup. The last time I looked.
Know him.
So
I know him.
At the time, in 1995, he said, after this bailout, by the way, you said the Treasury put in $50 billion and made a great return. They didn't even put in the 50. They just risked it, and they didn't have to put it in, as it turned out, in some sense. Here's what Buiter said. He said, "This is not a great incentive for efficient operations of financial markets because people do not have to weigh carefully risk against return. They're given a one-way bet with the U.S. Treasury and the international community underwriting the default risk. That makes for lazy private investors who don't have to do their homework figuring out what the risks are." And I paraphrase it as, all profit and no loss makes Jack a dull boy. If you don't risk the downside, you're not going to be as prudent as you would otherwise be. The other point I want to make, and I think it's just really important, you've really touched on in an important way, is the way it was sold. And we talk on this program about the bootlegger and Baptist hypothesis of government regulation. So the bootlegger and Baptist, you have a bootlegger who wants liquor sales to be banned on Sunday so that he can make money selling illegal whiskey out of the back of his back of his car. The Baptists don't want liquor sales on Sunday because they think it's God's day, the Lord's day, and it's not appropriate to drink on Sunday. So the politician bans liquor sales on Sunday because it's the Lord's day. He doesn't mention the fact that he's making a lot of bootleggers happy. And this is a perfect example of it, and it disgusts me that my profession continually justifies these kind of bailouts looking at the upside. Oh, we saved the world. There was no crisis. We made sure Mexico didn't default. That could have thrown things into turmoil. It would have been bad for Mexico. We could have had a recession in the United States, all of which is true. Possibly, though we'll never know. We don't know whether Lehman Brothers would have gone bankrupt or would have had a catastrophic systemic problem as a result. What we do know is that they later had an even worse one because they had been incentivized to be less cautious with other people's money, and other people were happy to give them that money because they thought that they'd get it back anyway. And so to me, this is, I don't know what the, quote, real reason was. I just know that the thing that gets waved around like a banner is we saved the world. What really happened is they saved Wall Street. And that was just the quiet part that nobody talked about, even other than the occasional remark from Willem Buiter.
Right. And I think it also occurred exactly at the same time that how banks were being run and how they were being structured was dramatically changing. So again, when I joined Wall Street, you still had companies, Goldman, for instance, which was a private partnership. And Salomon Brothers had been a private partner. They were one of the first to go public, I believe, in 87, 86. But I had gotten there early enough that a lot of the senior management had been partners and still behaved in a way in which they thought of every decision as the way they thought was, is this a prudent risk to take for me, not just for the bank, that is. I mean, not just for me. So there was a real, and that changed as the companies got larger and became more bureaucratic, and traders like myself didn't have to put our money at risk. That really changed how people took risk. The two combine the fact that it wasn't your money at risk, and even more, the fact that now government, in some senses, was underwriting failure, really incentivized people to just go crazy.
So you and I've followed you on Twitter for a while now, and I've read a number of your essays. You and I we don't agree on a lot of things politically.
No, that's right.
But we agree on this. So why is it, do you think, that we don't have more company? There are people who are angry about the bailouts. There are people who are angry about TARP. Why is it that so many – what are your thoughts? Well, let me ask it a different way. When you think about your colleagues at the time and the management above you, if you told them the way you see this, the effects of this, would they say, yeah, I think you're right? Or would they say, no, you're over-exaggerating. It really was necessary. It's important, blah, blah, blah. What do you think other people think about this?
You get kind of two camps. You get, and I think the bulk of the camp is we needed to do it, which is and again, not to get too political here, it's just the kind of what I call the squishy middle of both parties, which is that we just need to do whatever we do just to get to promote growth and move on, kick the can down the road crowd, and I call them the technocrats, who just looked at it from a sheerly numbers perspective and said, hey, Mexico growth did better, U.S. growth did better, the stock market did better. It's kind of these people who only really look at spreadsheets and how they analyze things. There was a rump on both in Wall Street of both political parties, mostly libertarian leaning people, who looked at it and said, no, this is just wrong. This is just wrong. But it's very hard to say something's wrong when it benefits you.
Yeah, well, that's let's be honest. Yeah, we all have our own inner bootlegger and Baptist. We know there are multiple reasons for why we do what we do, and we tend to focus on the ones that we think are high-minded rather than self-interested, which is really.
It's hard for me to really try to explain to people how out of control Wall Street got. I was there from 93 to 2012, and even from 93 to the crisis. It was just speeding up and speeding up and speeding up, and it was hard for me to really grasp what I got myself into, coming from absolutely no financial background when I got there in 93. But it seemed kind of in control, but moving out of control. But by 2005, it was completely out of control.
But at the time, in 95, I assume your main reaction to this set of events was relief.
Oh hell yeah! I mean, I could go on. I finally got to go on my vacation in February. I mean, and it believe me, I got paid a lot. I mean, sure. Let's be honest. I had gone from making $12,000 as a grad student to my first year, as a research guy, getting paid $180,000. That's you rarely get a bump up in pay and magnitude.
Yeah, and that's real money back in 1995.
Yeah, for somebody who was a PhD in physics who thought I was going to make $30,000 a year. I mean, that was big, and those things really impact you. You can try to be as ethical as possible, but when you get money waved at you,
it's very hard. So let's go ahead in the timeline. Let's go to 2008 with the TARP bailout of, I think it was 700 plus 710, 720, right. $20 billion. You've written about how, and I've talked about how Paulson came to Congress and said, if we don't get this money to give to the banks, the world's going to end, literally said that. And incredibly, Congress said no. So what was the reaction? Talk about what happened in the trenches and what were you doing at that time, and how did you guys react to it?
I was a proprietary trader at that time. I was risking the bank's money, and
where were you working?
I was one of the.
You weren't at Solomon Brothers anymore, right?
Yeah, I was at Citibank. Solomon had become Citibank.
Yeah,
through various mergers. We had been bought by Traveler. We had been bought by Smith Barney, and then they were bought by Travelers. So we were a Citigroup at this point. We had gone from a company of 5,000 to a company of 250,000, and so. I had been one of the people who had been skeptical about the market's dramatic rally, credit markets from basically starting in 2003 So I had been skeptical, but gotten run over. And they say, I kept expecting this to happen, but much earlier than it did happen. So I was in a seat where people around me lost a lot of money, and the firm lost a lot of money, and people 5 rows over, 10 rows over lost $50 billion. I mean, tons of money. And, you know, I had expected the markets to blow up. I hadn't expected it to get as far as it did. I think there was just a sense of disbelief that, you know, there was this people who were really, you know, there were a lot of people personally who were just very leveraged, and they were like, you know, I don't know what I'm going to do. The banking sector is collapsing, and I have a vacation house in the Hamptons. I have 5 kids in private school. What am I going to do? People were personally miserable. But the situation at the time, right up to TARP, I'll never forget when someone mentioned that, you know, this idea that there was going to be a bailout. It just propagated through the trading floor, like almost as if, you know, everybody immediately fell in love. It was just this.
It's a cure for cancer.
Sorry?
It's a cure for cancer.
Yeah,
it's
the trading floor's mood. I remember when the rumor first broke, the trading floor's mood just it went from somber to laughing and high fives, and it was interesting. There was, you know, looking back, there was never a moment once the rumor came out that anybody expected it not to happen. It was just a sense of, and I don't know if you remember when the first vote came in the House of Representatives. Yep. The first vote failed.
Yep.
And I remember came at like 4:30 in the afternoons, 3:30 in the afternoons, and we had all been told it was going to pass. Everybody just assumed it was going to pass because this was so obviously right. You know, I forget, was it 700 billion was the number?
It's 720.
There was no. It was just a bill saying we're giving
us money. Yeah.
But with no real details. And so I remember us watching the vote on C-SPAN on all the trading floor. And as the vote clearly started turning to being lost, people just didn't believe it. People just looked at it and said, no, don't worry. It's going to turn. It's going to turn. Even when the numbers just, you know, were clearly there's no way it could turn. There was just this immense denial. That's how certain people were that it had to happen. And it really was vouched that way. This has to happen.
Yeah, they were right, of course. Because all Congress really did is say, you know, Paulson showed up basically with a piece of paper and said, it was like, seriously, I've talked to people on Capitol Hill about this. He showed up, I think, with a single sheet of paper that said something like, just give me this blank check. And they said, are you out of your mind? It doesn't work that way. They voted it down. And then as a friend of mine once said, to my horror, well, then they fixed it, right? No, they didn't fix it. They larded it up with a bunch of pork for Congress. The final TARP bill has all kinds of special provisions that are just unbearably painful to read about. You can go back, you can read them. You know, the special payoffs to a car manufacturer for their green car that somehow other cars don't get because they're not the right kind of green, and a lot of payoffs in that.
You know, one thing that, you know, putting my pro TARP hat on, my old banker hat on, you know, it really was. It really did save the markets in some senses, you know, but it came with no strings attached. Where we differ, you know, where we probably differ in terms of what we feel about it was just $720 million, billion that came really with no strings attached. And if there ever was a time to attach strings, to say, oh yeah, okay, guys, you know what? The way I put it is, people say, well, look, TARP made money. It made money because you're not accounting for it. They sold it cheap. There was nobody else willing to offer Wall Street $720 billion of money with no strings attached.
Yeah.
You have to charge people when you give them things to save them. So Treasury made money only in the sense that it gave it away free. Had it actually charged the market rate for what they offered, and think about it, they offered Wall Street basically savior, salvation. You have to charge a price for salvation, and they gave Wall Street salvation at no charge. So of course it made money with no charge, but that's just not proper accounting.
Yeah.
And so, you know, I always tell people that there's a lot of details that got glossed over, but in the bailouts, there were all different things you could have done. You could have asked Wall Street to take a loss on certain products. They call it a haircut.
Yeah.
We were prepared to take it.
Tim Geithner
we were prepared to take a Wall Street haircut. I had a spreadsheet built of, just accepted, here's what's going to happen if we take a 50% haircut, And Wall Street, for all its problems, are generally, I use the term, we're big boys. We can take losses sometimes. That's kind of what we're supposed to do. And so people were prepared to take a greater hit than they took. And the government really played their hand very badly in that sense.
Yeah,
they could have got a lot more concessions. Yeah, and they could have got a lot more out of the street than they did.
Well, Tim Geithner said no haircut. People started to try, people negotiate. People, as you say, AIG and others were willing to say they're willing to take something, or they could have been asked to take something, and they were not even asked. And you say they played it badly. I think they played it very well in the sense that they took care of their customer, which was Wall Street. I think it's for us, the non-bankers, they played it badly, but I don't think that was their goal. It's like when Hank Paulson talked to Lloyd Blankfein 30-something to 20-something times before the TARP came out. My joke was they weren't talking about what their kids did over the summer. They were talking about, I'm sure, Blankfein was explaining to him that this was absolutely essential, and I'm sure they both convinced themselves they were doing God's work when, in fact, they were sucking money out of the rest of us and making sure that nobody lost their house in the Hamptons. And that's unacceptable.
The power of bubblethink is extraordinarily strong, and you become part of the culture. Everybody's friends with everybody. Everybody thinks the same way. Even if you don't feel like you're corrupt, if you're not, you're trying to do your best to be ethical, you're part of a system that is by nature corrupt. Now, one of the things that the other little dirty secret from the TARP period, from the crisis, the individuals most responsible for the losses, the people who lost the $50 billion, the people who made the decisions that lost the $100 billion, they personally did very well. So, if you look at like 250,000 employees at Citibank, 240,000, 235,000 employees did their job and made money. It was the 15,000 employees who lost $100 billion who did, and that segment of the people who lost, and that's not just that. I'm not just talking about Citibank. I'm talking about Lehman. I'm talking about all other firms, Bear Stearns and Bank of America and Merrill. The people the individuals who generally lost the most money did the best financially. So there was really nobody who came out of the crisis who should look back and said, I feel bad about what I did. From a very selfish perspective, they did well financially.
Well, you said no strings attached. There was a government policy in place, Fiducia, that had strings attached that basically said when you blew up, management got replaced. TARP was basically an extra legal, ad hoc, cobbled together way to avoid that. And the other point I think to make is that, and you said they did very well. The leaders of Bear Stearns and Lehman, just to take the two examples that got a lot of attention, Jimmy Kane and Richard Fuld, they, quote, lost a lot of money when the equity portion of their investment was wiped out. They were still left with an enormous amount. So it's not like they were I like what Jimmy Kane said, the only people who are going to suffer are my heirs, not me, because when you have $1.6 billion and you lose $1 billion, you're not exactly like crippled, right? So yes, he lost $1 billion relative to, because he rolled the dice and he lost, but he's left with $600 million, and he should have maybe arguably lost it all. But he didn't.
What was Chuck Prince's payout when he got fired as CEO of Citibank? In 40 million, you got a 40 million parachute, 30 million parachute.
But that's peanuts compared to, Fuld also lost $1 billion of paper wealth on the equity that he lost in Lehman, but he kept over $500 million
Yeah, they did well.
They did well. People say, oh, they did pay a price. Well, they paid a price relative to what they could have paid if the world had worked out perfectly the way they had hoped. But that's not the way capitalism works. Okay, so let's when I'm going to get down off my soapbox now, return to the Chris Arnade story. Sorry. So when this happened, when the second vote occurred, TARP did pass, lots of happiness and celebration on the floor. What was your mood personally when that happened, and why did it change over time? What happened to you that changed the way you perceived it?
I was getting, if you had asked me, 2002, 98, what I thought about Wall Street, I would say, hey, look, it's not the best thing to be doing with your life ethically, but it's benign. It's not positive, but it's not negative. It's a job. 2008, 2009, I'm starting to realizing, hey, man, we really messed up. This is no longer we did some bad things. And I had thought at the time, I had expected everybody else to come to that, or a large majority to come to that same conclusion that, boy, we had done some really bad things. We got to change. What I found was the exact opposite, that people said, well, what do you mean? We didn't mess up. We didn't do anything. What do you mean? I had some jaw-dropping conversations on the Citibank trading floor with people who had just gotten bailed out. I mean, Citibank was saved. We were saved. Our stock went down from 52 to 2, and the government stepped in. And there were people who ended up on guarantees getting paid, saying, well, "What do you mean? I can't. How dare the government, try to tell us what to do? We didn't mess up. We didn't mess up at all." And that was really disheartening to really feel like you're now almost, in this company or in this industry that you no longer respect. I stayed there for another 5 years. I did proprietary trading. I was left alone. I started at that point pivoting most of my personal time to my photography and doing things outside of work. And I just became more and more disenchanted with Wall Street and how the industry behaved.
And at some point you quit. And
yeah, in 2012, I quit. And we went our separate ways as I took a package and left. About 2010, I had started, during the crisis and prior to the crisis, as a way to relax, I'd go on long walks through New York, really long walks, like 20-mile walks to neighborhoods where most people don't go. Some of those walks took me up into what's New York City's poorest neighborhood, Hunts Point, which is in the Bronx, which is by all metrics one of the highest crime, the average family income of $19,000, and I was spending more and more time up there, documenting and just spending time with people who were homeless street addicts. So I had this really surreal 2-year period where during the weekends and at some nights I was documenting and taking pictures of street addicts, people living in crack houses, and then during the day coming and working on Wall Street.
Different kind of addicts.
Trading. Yes, and at some point something had to give, and it just got to be too weird, and I stopped paying attention to my job, and so I said, look, I got to get out of here. And I left Wall Street. And for the last 45 years, I've been focused on my photography and writing.
So besides Hunts Point, you've also been in a lot of rural communities in West Virginia and Kentucky, if I remember correctly. What are you looking at there? Who are you talking to, and what are you trying to understand?
I've been for 4 years, 3.5 years, I studied addiction and poverty in the Bronx. And then about 2 years ago, I said I needed to see the rest of America. So for the last 2 years, I've been driving. I put 150,000 miles on my car in that time, just driving to communities, I always say, where people live, but people nobody visits. I was just in Prestonburg, Kentucky, which is a coal mining town in Kentucky. I was in Kingsport, Tennessee, which has the highest heroin addiction in the U.S., one of the highest. El Paso, Selma, Alabama, Buffalo, and I'm going to Milwaukee. I'm looking more and more at trying to understand poverty in the United States, addiction. And what I'm seeing, and I'll compare it to my experience in Wall Street is what I'm seeing is a part of America that is, I've come to the conclusion based on those two experiences that there are two very, very, very different Americas in this country, and neither of them understands each other. And one basically Wall Street people and others like them have an amazing advantage, and the rest, people in Selma, Alabama, people in Prestonburg, Kentucky, have an amazing disadvantage.
So the people in those poor communities, now, one of the things I think it's important to remember is that these communities are shrinking. For the most part, people are leaving these poor towns. They're going to different cities. They're going to bigger towns and bigger cities. So it's sometimes misleading to look at the people who are there, say, compared to 25 years ago, because it's not the same people. And opportunities are not there anymore. And the economy is not healthy, either because coal's not in demand or because the educational skills of the people who are there aren't so useful. And so the ones who do have the good skills just leave to go do something more productive and more meaningful elsewhere. But for the people who are there, we have this impression, there's sort of this revolt against the elites, against globalization, against free trade. And how much of that is, in your perception, is the elites' imagining of what's making people angry versus something else? How aware of it are they? Do they talk about it? Do they see themselves as victims of policy decisions in Washington, whether that's accurate or not? Do they see themselves that way?
I mean, they do see themselves as victims of policy decisions. They may not be as fully informed about those policy decisions as people would like them to be. I think what sticks out to me is the anger. The anger is kind of three-pronged. One of it's very much social. It's just sense of feeling kind of diminished in terms of people caring about them being made fun of. Everything they do is laughed at. If they like NASCAR, that's made fun of. If they vape, then that's considered wrong. They eat at McDonald's, that's cheap. So there's this kind of just, if they go to church, they're considered silly. So there's just sense of just feeling like they're very much being mocked in terms of their lifestyle. But in terms of policy, I think there's a sense of, there's two frustrations. There's one frustration at immigration, the idea that companies are just picking, and in so many towns you go to, the factories are just gone. If there's a factory, it's just a rusted steel hulk, and it's gone. And that's a very visceral to people, this idea that their factory has picked up and moved. And then there's anger at TARP, at the bailout, at this idea that, there's two sets of rules. There's a set of rules for me. When my factory moves, I don't get a bailout. But when Wall Street, collapses, they get a bailout. So they may not say to me, hey, I really don't like the fact that AIG didn't get a haircut and it was unfair, but they say, I can't believe Wall Street got a bailout. I can't believe that when they failed, someone was there to help them. Their buddies were there to help them, and nobody's here to help me. So it's kind of three kind of sources of anger I see.
Okay, I want to talk about the first one because it interests me. I'm constantly trying to remind economists that money isn't everything, and that although work is nice when it brings money, one of the things that also brings is meaning. And I think the problem of the lack of employment in the United States as we've recovered from this recession, especially among less educated Americans, is a huge problem, not because they're poor and unemployed, which is unpleasant, no doubt about it, but because their life is not as meaningful and worthwhile. So I totally understand that. What I wonder about is this idea of respect. Certainly, respect is hugely important to our sense of well-being. But when you say things like people don't respect NASCAR, church, vaping, McDonald's, and among my friends, that's true. Among the people I hang out with, generally higher educated people, those are all the attitudes they hold. But are the people who are enjoying those things, McDonald's, et cetera, how do they perceive that they're not respected? They don't hang out much with people on the coast, say, who are telling them that Is it something they're perceiving on television? Is it something they're reading about?
I think it comes through. The media, but I think
or is it something that we educated people have convinced ourselves about them that isn't really true? So that's what you're talking to them. I'm kind of.
I think it's a little bit of both. I think, but I feel like, I don't want to get overly simplified, but I guess I really do think there's two Americas, and I think the America that's doing well dominates the media, dominates the culture in terms of, sociologists always talk about there's an in culture and there's an out culture. And we signal in ways of being in the in culture in terms of the television shows, in terms of what's on movies and what's made fun of. And I think there's a fair amount of people who make fun of the culture of poverty in terms of, how people get by, if people go to church, if people, go to NASCAR or those sort of things. I think it does filter across through the media. And I think some of it also is, comes from a place of being frustrated already and then taking any perceived slights, magnifying them. So, we may not be they may be more overly sensitive than they should be, but that comes from a place of also being just frustrated economically, feeling very much like they're left behind.
So I talked to... recently spoke with Angus Deaton, which I think will air before this episode does, and we've talked to others about the rising mortality in the 45 to 54-year-old white non-Hispanic class. And Andrew Gelman has pointed out it's mainly among women, not men.
Yes, it is. That's right.
Have you?
It is.
People are speculating it's despair, it's people overdosing on drugs or trying to get high because their lives are so bad. Again, as a very casual street sociologist, what do you see that might be relevant for that discussion?
I was just talking to a minister in Prestonburg who just buried a 38-year-old woman, one of his congregants who shot herself in the stomach. And I spent time in the 9 days in Prestonburg. Some of it's just boredom. Some of it's just, I always say that, I spend most of my time with addicts, both of all races and all types. I always say where I see hope leaving, I see addiction entering. Where there are places where people don't feel, the old term is enemy, where they don't feel integrated, where they don't feel part of the community, where they don't feel valued, where they don't feel a sense of regulation, where they feel kind of aimless, meaninglessness. That really is where you see a lot of addiction. And addiction is on the same spectrum of suicide. It's a different form of suicide, a slower form. But what drives addiction drives suicide. And in both cases, in my mind, it just comes from a kind of aimlessness, meaninglessness. And it's very hard to say why. To say this is due to this. In my mind, it's a whole bunch of different things. But a lot of it comes from whether or not it's fair to believe it. A lot of people feel very left behind and very isolated. And you can argue that they shouldn't feel that way. But that is the way they feel.
It's not a helpful, response, actually. But I understand the urge. No, not on your part. I mean, I'm agreeing with you. I think the urge to say, well, they shouldn't feel that way. There's all kinds of great things happening, and they should be taking advantage. Kind of doesn't matter if they really are in despair.
My feeling on this is relatively probably different than a lot of people, which is, and it's hard. And again, it's one of these things where it's really hard because it's hard to say these things because they don't have numbers assigned to them, and we like to look at things in numbers. But I just feel very much like we've shifted over the course of my lifetime, at least, to valuing things over valuing community, valuing material things. And in a lot of these places where people are frustrated, material things are hard to get. They're hard to keep up with. They're hard to, the rules are stacked against them. And so they have to rely on, they rely on community. And I think we value community less than we used to. And I think people know that. So as you said, people leave. So you go to a small town that's lost its factory, and the people who can get out, who want to go to New York City and make a lot of money, get an education, they leave. And what's left behind is people who know they can't get out. They watch people doing better than themselves who say, bye, I'm gone. And it's just this real sense of, hey, I'm here I've been left behind. And part of that feeling of left behind is some people didn't have a choice about being left behind. Some people stayed because they wanted to care for their family. So, they didn't do so well in school early on because they had some strikes against them, because they had a lot more complications in their personal life. They put value on other things other than just education. And we move so quickly these days that if you start falling behind early, by 19, 20, you're gone, you're behind, you're over. So if you didn't do so well in 6th grade and 7th grade and got pulled, left behind, and you didn't get on that escalator moving up quickly, you're kind of stuck where you are, and you're made to know that.
Yeah,
because
so there's two parts to that. I mean, I think about this a lot. I mean, there are two parts to that. One is the first part, which is you are left behind. You don't have the financial, material well-being. I don't think people have gotten any greedier or emphasize things more than community than they used to. But it is true that there are a lot of people with a lot of nice things. So when you say there are two types of America, I think that's always been true. The question is, how big are they relatively? And it's not just the people on Wall Street are doing well. There's a large group of Americans who are doing very, very well, and standard of living, I believe, is understated in terms of how well the average person's done over the last 30, 40 years. But that doesn't matter. It's still the case that people at the bottom are really, I think it's ever more painful for them seeing what other people have. And you do perceive that on television. You do perceive that in the media. And I think then the question is, how important is that perception? And then the final thing is, which I want to close with because you've written some interesting things about it, is that people do find community. You write about how McDonald's is the town square. So talk about that. What other forms of civil society and communal interaction you're observing in these very poor places?
Right. One of the things that I'm kind of pushing back on is the whole bowling alone idea, which is, this idea that there isn't community left. And there is strong community. It's just not found in places. It's, one of the things I observed because I was spending time with addicts is you spend a lot of time in the McDonald's, and I'm on the road, you spend a lot of time in McDonald's. And part of the reason you spend a lot of time in McDonald's is because that's where people go these days in some poor towns to rest, to have a free Wi-Fi, to have a clean bathroom and a place to plug in their phone. It's also where people go in the morning to meet each other. There's these morning groups in almost every town. These I call them old man groups, where they come and meet each other, and sometimes they're very formal. There are 30 people who come each morning to have coffee with each other. So even in these places, in these poorer communities, there's a lot of community. I call it ad hoc community, self-built community. Yeah. It takes places in places like McDonald's, and that just tells you how overwhelming, that they're doing it in a franchise whose goal is fast food, and it tells you how strong people's urge for community is, how strong people's urge for being social is. And what I've become convinced of more and more is, in many ways, what's happened to poor Americans is they have less community in their workplace. There's the work is less meaningful than it used to be. You used to work in a factory. You had a bunch of other factory workers who you could hang out with. But if you work as a cash register, or you work kind of, sales rep or something like that, or you work in a fast food franchise, even there's less of a community in the workplace. And so you form community outside the workplace, and they're doing it in these very ad hoc manners, and it's working, You see it in churches are becoming even more important in small towns, and McDonald's are, and Walmart parking lots, even in places like that.
Yeah, what's happening in Walmart parking lots?
I mean, like in Prestonburg, you have these tables, that line the Walmart where people just hang out on Friday nights. So just the teenagers go there to hang out, and they meet there and they all hang out and they organize, and sometimes they drink beer there and it's gotten so bad or so good as it is that the police now patrol it. They patrol the Walmart parking lot with a dedicated policeman on a bicycle. Because so many people hang out in the Walmart parking lot because that's their community in some senses.
So what I think has changed, and we've had a lot of conversations on this program about the future work and jobs and artificial intelligence, robots, et cetera, and the challenges and wonderful potential that all this has. What seems to me that's changed, you really hit on it when you talked about people in the 6th and 7th grade falling behind. Public schools in America have never been great in the poorest parts of the country, and in the richest suburbs, they've always been pretty good. And people, when they talk about my friends who rail against public education, conveniently forget that in the public schools in the rich suburbs are pretty good. In the poorest parts, they're awful. And there's a lot of reasons for that, some of which is, I believe, the publicness of the schools. But that's not the only problem. I don't want to pretend that that's a magic solution. I do think it would make things better. But I think what's changed in the economy as a whole is that, in the old days, meaning 1950, 1960, 1970, a person who didn't finish high school, it was a disadvantage. Some of them succeeded, some struggled a little bit, but he could have a decent life. That's not true anymore. And that's mainly a good thing in the sense that the same way that when the car got invented, you couldn't make a living as a blacksmith. Okay, fine. It's not, people who wanted to be blacksmiths are going to have to find different things. The challenge is that for some folks, falling off that escalator of progress from school to high school to college to career, it's much more debilitating than it was 50 years ago. And we haven't, as a country or as a community in these towns, figured out the way to help those folks stay together, seems to me. What's your reaction to that?
I think that's very fair. I think the flip side of the advantages of an education growing is that the disadvantages of not having an education are also growing. I say that broadly speaking, we've kind of shifted from sorting by race, and which was bad, to kind of sorting by education. We tend to reward people who have a Wall Street trader is more similar to a professor of sociology at Harvard than he is to a truck driver. They have more in common in terms of how they think and how they behave. And I think the people who are really suffering are the people who don't have that ability or desire or whatever to get an education. And I think it's becoming harder and harder to get by with less and less education. And I really don't know how to solve that. I mean, I don't know.
I don't either. I have some ideas, but that's probably for another episode. But thanks for your work, Chris, especially out in the field. I think it's really provocative and interesting. And we'll put up links to your Flickr page where people can look at your photographs and your Twitter account and read really interesting stuff there.
All right. Well, thank you very much for having me. It was really wonderful discussion.
My guest today has been Chris Arnade. Chris, thanks for being part of it.
All right. Thank you again.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.